Fourscore, like the Gettysburg Address, named after the kind of the motto of and the mode of Fourscore and the Gettysburg Address being to do things simply and concisely, but have a big impact, and that you don't need more, where less can drive home everything you need and drive home big points. And so everything that we do, we kind of orient around a motto of ideas deserve opportunity. And from that, we've developed a few different principles around helping drive different ideas that individuals and businesses have, and helping provide pathways for growth towards ensuring those ideas can actually become real world opportunities. So everything we do, we try to simplify the complex. That's going to be a big thing we're going to be talking about today in terms of some new stuff we're doing with preferred financing work. We always try to create different opportunities for clients to pursue different billing avenues and pricing models. So we try to do a lot of work on flat fees, and we have subscription based billing structures for clients who need a lot of regular legal work. And it's really us trying to move as much as possible to a more clear and upfront understanding of what you're going to be paying for legal services, and moving as much as possible from that unexpected archaic model of just hourly billing. Some of that's challenging because things for big deals where you're raising money, you're trying to sell your company, it's really hard to estimate all the work that's going to go into that. And again, we're going to get into some ways that we're trying to help simplify and streamline that process for financing rounds. We do everything we can to provide superior work quality, and always do our best to respond swiftly to our clients. We break up our practices into 3 areas. So our biggest kind of bread and butter is around venture and angel financing, and also mergers and acquisitions. So those are our 2 big things. So as clients are getting ready for those rounds, we help them prepare for those rounds, undergo those rounds, close those rounds, and then help kind of facilitate the process of having a major investor after that through some different services we provide. But we've got clients who are at all different stages of their life cycle. But for the most part, everybody is kind of pursuing different avenues of growth, pursuing potential venture or angel financing and a potential exit of some sort. So the kind of 3rd area of practice that we think of is this general counsel services. And that's basically everything else you might need. So we do, all the startup work, template drafting of contracts, negotiating contracts, dealing with employment issues, leases, intellectual property licensing, disputing contracts, drafting different contracts. And we have a network of external legal resources who are specialists in different areas. So we're really able to provide kind of a full set of legal services for all of our clients' needs. So like I said, today we're going to be talking a lot about the preferred financing rounds, whether you're gearing up for a Series C or a Series A. But I thought it'd be helpful to just kind of provide some context for approaching those rounds. And I think it's really helpful to always think about different avenues for receiving financing and the motivations behind those potential investors, because that's really helpful in thinking about how to approach these different types of financing rounds. And again, we're going to be focusing a lot on angel investors, venture capital, those kind of folks who'd be coming in. But this slide deck, and we'll make these slides available as well, but I think it's really helpful just to think about, if you're going to be doing friends and family, a lot of times those people are going to come in early because they really care about helping you. They also care about a return, but they might really just believe in your idea, believe in you, and want to help you. If you're turning to the crowd, people just who might not otherwise usually be able to invest, are just excited about having opportunities for different returns. And really, as you start to get into bigger types of financing, like with angel investors, venture capital, banks, things like that, really their main thing they're going to be thinking about is around returns. And so it's really helpful to think about that in the context of what these investors are going to be looking for is money, the potential to make money. And that, for better or worse, is what the kind of VC startup ecosystem is built around, right? So that's why you see these stories of companies that come in, you're around maybe just for a couple of years, you're raising a bunch of money. The idea is that you're trying to develop a business that provides value to the world and to your customers. But the idea in the end is you're bringing these investors is really just to turn a profit as quickly as possible, essentially, and to make money through some kind of exit in the future. And I think that context is really important when you're thinking about how to deal with angel investors or venture capital.
Totally. Yeah, real quick, Sean, I just want to, for the new people who are coming in, feel free to introduce yourself in the room chat and share what you're working on and everything. And if you have questions for Sean as he's going through this, just drop them in the room chat, or you can click the raise hand button at the bottom there, and then we'll bring you up on stage and you can ask Sean as he's going through this. But yeah, introduce yourself, share what you're working on, all of that. We want this to be very open and let people really, get the chance to ask, a very smart person and a lawyer some questions about raising capital and how they should be approaching investors and stuff like that. But no, this is great, Sean. You can continue. I just wanted to share, reset the room real quick.
Yeah, I can't see the flow now, so please, definitely stop me if people.
No worries.
It's also really important to recognize that selling like preferred stock specifically is not your only option for raising money. It's certainly one of the most common options for high growth startups who are like going down that kind of traditional startup path, that at some point you'll raise money through a preferred stock round. But it's always worth remembering that it's not your only round. There's lots of grants out there, either through government agencies, nonprofits, like industry specific groups that are passionate about trying to foster innovation in different areas. Universities, different groups like that all have different grants available. And the value of grants is that they're not dilutive, right? You're not giving actual equity out to anyone who's giving that funds. So you're not necessarily giving up any of the benefit of the company. You can do things like convertible notes or safes, or other types of debt, like finding an actual conventional loan or line of credit. You can always try to get investors who would be willing to purchase common stock as well. Although if you're dealing with an angel group or a venture group, that would be less likely. And I'll get into a little bit more like really understanding why people would want preferred stock over common stock. You can also do things like revenue sharing agreements or profit sharing agreements or things like that, which would also be non-dilutive. And so it's just important to remember that like you don't have to go down this route of selling preferred stock. You don't have to it's not the only option if you're trying to raise funds. It's also really important to just understand exactly what it is if you're gearing up for a preferred stock round. So like if you're getting to that point and people are telling you, you're approaching time for a Series C or a Series A round, like that, again, that's just kind of the lingo everyone's used to hearing, but sometimes people don't really stop and think about what that means. And preferred stock is actually a totally different type of stock that you will create as part of a preferred stock financing. And it's completely different than the type of stock that you as a founder would have in your company. And so part of the process of convertible note financing is drafting a bunch of documents that go to create the rights that come with that preferred stock. And preferred stock usually involves giving preferential treatment to those preferred stockholders if you ever sell or liquidate the company or issue dividends. So I won't go into like specifics of all that here, and it can fluctuate between deals, but the idea is that they're preferred, so they're getting the preferred treatment if you ever sell the company, like they're going to get paid out first. Usually the major investor in your deal is going to ask for a board seat. And then usually, among other things, there's going to be requirements for the investor or their board member to consent to certain significant company activities or milestones, such as like if you're ever going to sell a new class of stock, or you're going to try to sell the company or expand the option pool or things like that, you would need their consent to do that. So you're giving up a lot of equity in the company by actually giving them stock. You're giving them preferential treatment over liquidation and dividends, things like that. And you're giving up a lot of control by giving up a board seat, by giving them the right to essentially veto certain actions that the company might want to take without their consent.
Real quick, Sean, do you want to go back to that slide? There's a question about you don't have, when you're issuing preferred shares, that doesn't necessarily mean that they're always getting a board seat, right?
That's correct. It doesn't necessarily mean this. This is just what it usually involves,
Right.
especially if you're raising funds where you have one kind of major investor who's coming in and contributing like 50% or more, or maybe even less, but like they're coming in as the major investor in that deal. A lot of times, if they're contributing a significant amount of capital, they'll expect a board seat. Other times, or in addition to that, investors might ask for a board observer seat, which means that they're not actually a board member, but they would have certain rights to come and actually observe and participate in discussions at the board meetings, but they wouldn't be able to actually vote on board activities.
Right.
So,
just attend the meetings.
Right.
Okay, cool. I just want to make sure that people that was clear for people.
Yeah.
Okay, cool.
So I'm going to flip over here and just show you one of the resources that we have that we kind of put together. I think it's helpful. Didn't too much. And you can, we've got a bunch of resources. I'll show you some other stuff as well on our website, which is fourscorelaw.com. But one of these resources is just a timeline that walks you through what's involved at all these different steps of doing a preferred round. And I won't walk through all the different bullet points here, but if you go here, it's just fourscorelaw.com, and then you can either like search for like financing timeline, or it's venture-financing-timeline. And again, I'll put all this in the slides that will be available afterwards. But you can see just like through clicking through this timeline how much goes into these types of financing. So it's a very significant undertaking. You're going to do a lot of work like cleaning up your company beforehand, because there's all kinds of different documents and corporate actions that need to be documented that the investors are going to look through as part of diligence, and they'll and kind of part of preparing for the seed round is getting all that in order and make sure everything is squared away so that you can have a clean data room for them to go through. And this can be one of the most significant undertakings as part of the preferred round if your company's been around for a little while and you maybe haven't been doing all these things and like keeping track of all this stuff as you've been going along. It'll just require a lot of that cleanup. So usually, like if we're running the deal for our clients, we're going to do a review of all your corporate documents that you have, and essentially clean up any documents that we need to draft or need to be in possible, so you can prepare for diligence. And again, I won't go through all these, but you can see then you're going to do some kind of substantial work, negotiating term sheet with the investors, and then you're going to also be working on a pro forma cap chart to show what all the economic terms around the stock you'll sell are. And that's what will show you how much your stake in the company will get diluted, how much the investor will actually own, how much money they're going to put in for how many shares, all that kind of stuff. And then once you have an actual signed term sheet, then you actually move into the kind of kickoff piece of the financing, which is really around drafting all the documents, doing diligence, getting everything in place, and all the rights in place to actually affect that sale. So there's a couple different steps around that, making sure you have everything in place from the agreement standpoint, securities law standpoint, and getting everything covered there. Both the investor as well as your lawyer would be doing some diligence and negotiations around diligence so that you can make sure that you are accurately representing the state of the company. And then once you get to a point where everything's kind of getting settled, documents are starting to get into final form, then you'll prepare for closing, which sounds like once you have all the documents and everything, you're good to go. But depending on how many current equity holders you have in your company, how many investors you have, closing and preparing for closing can also be another significant piece of this, because you have to collect signatures from everyone, which can always be herding cattle if folks are not are not quick around signing all the documents they need to sign and everything. And so once you get everything together for closing, then you can actually move to closing, which sounds like a big deal, and it is, because that's when the wire gets in place, but it's actually a lot of times one of the easiest steps, because the idea is you've got all the signatures in place, you have all the documents finalized, and then it's closing. You're essentially just releasing the documents, making sure everything's in place, providing the investor with any sort of information they need, providing them with the wire information, and then they send you the money, and you get to see a very exciting change in your bank account all at once. And then after closing, there's still a little bit of work to do. Your attorney's got to file some securities filings. You'll issue stock certificates either through an electronic cap table system, or if you don't use one, like you'll issue actual like PDF or physical stock certificates. You'll update kind of cap chart ledgers stuff. Your attorneys will put together an actual closing binder and share it with you and the investors. And then you'll deal with some kind of other things like 409A evaluations and stuff to position you for moving forward effectively.
Hey, Sean, real quick,
Yes.
you want to mention some of the, I saw you had Carta there. What do you recommend for people to use for cap table management? What's the easiest? Because we, right now, well, we use Gust. I know a lot of other people have Gust as well. We might need to switch as we raise this next round, and I have to look into their platform a little bit deeper for more like for price rounds and stuff like that. What do you usually recommend Carta for people? Have you worked with people using Gust for later rounds of funding as well, or what other platforms do you recommend for people as they're continuing to raise these rounds of funding?
Right. Yeah, I would say that the most common ones we see is Carta by far, and then Gust, and there's another one called ShareWork, but it has an electronic cap table software as well. The value, part of the reason that I like Carta is from like a very early stage company standpoint, they have you can potentially qualify for a free version of their platform called Carta Launch. And that's really nice because it can help you get set up and keep all of these things together from the start. That way, that whole cleanup process when you're preparing for the financing is a lot easier and more smooth because you have all that in one place already. Carta and some of the other services as well also have ways that you can kind of play around with starting points for pro formas. And kind of just model out exactly what might happen during different scenarios for a financing. So that's really nice as well. And then Carta just makes it really easy. So do the other services, but really easy to like manage option grants and things like that. So that's why a lot of times when we're dealing with clients, we like to get them onto Carta. But we are pushing very hard for all of our clients to get onto some sort of electronic cap table management software. It just makes the whole process a lot easier and smooth, and everything's in one place for everyone to access.
For sure, that makes sense. Yeah, I think they also do 409 valuations through this.
Yes, yeah. Carta does 409A valuations, and so that's another benefit. If you're already on there, it makes it really easy to do that through them.
Cool. All right. And real quick for people who just came in as well, if you have any questions for Sean, just drop them in the room chat, or feel free to raise your hand. We'll be bringing some people up as well if they want to ask some questions directly as well. Thanks.
Well, I'll put this link to the...
I actually already dropped the link. Yeah, I dropped this venture financing timeline, and then I also dropped the preferred stock financing too in the room chat as well for people.
Perfect. So that's what I'm gonna flip over here to now.
Good. Nice. Cool.
So as I was mentioning, like a lot of what we do and really what I'm passionate about is trying to streamline different types of legal services as much as possible. And it's consistent with like how we're trying to move as much as we can over to like flat fees or other types of billing structures for clients, so you have a better expectation of what you're getting for what amount. And again, things like financings are a little challenging to do that because a lot of it is just unpredictable as to how much time and effort will be required, both on the legal side as well as your side, on your side, and being involved with this, as well as if you have an accountant or other people involved in the deal. But what we've done through this new preferred stock financing services offering that we've put together is try to take a chunk of the stock financing and streamline that. And so I'll walk through here a little bit of what this is. And again, this is on our website. You can easily find it in our preferred stock financing services. And there's a PDF of it as well that you can download at the bottom. But so the idea here, again, if you go and think back to the timeline that I was walking through, is that a lot of drafting and negotiating the term sheet and the pro forma revolves around negotiations with the investor. And so that piece can have a lot of uncertainty. But once you have a solid, complete term sheet in place with your major investor or your lead investors, if you don't have a single kind of major investor who's leading around, a lot of what we've done is to say, okay, we can take that piece, and then we've tried to automate certain parts of the document drafting process, which is still a huge, like it's a huge undertaking in the financing piece. And so by being able to kind of automate and streamline that process, we've been able to really cut down on a lot of the unnecessary like time and effort you might need to use into going into that piece. So a lot of what we've done is, again, this is going from the idea that you've negotiated and signed an actual term sheet. So we're at the point where you have an actual executed term sheet. We would work with you based on that term sheet to kind of build out the pro forma. And then usually in preferred stock financing offerings, and this is not always the case, but usually you're going to be using 5 primary documents in the document set that will be governed by the term sheet. And that's, you're usually going to amend your articles of incorporation or your certificate of incorporation. You're usually going to have a stock purchase agreement, a investor's rights agreement, a voting agreement, and then a right of first refusal and co-sale agreement. So there's 5 agreements that are usually going into place to affect a preferred stock round. And again, that sometimes for smaller preferred rounds, like you don't use all those, but if you're dealing with a venture group or an angel group, like a big angel group or any sophisticated investor like that, a lot of times they'll be using 5 primary documents like that. And a lot of times they're based off of some standard language that was created by the National Venture Capital Association. So a lot of times everyone is kind of working with a similar understanding as to what will be in those document sets. And so we've taken those and things like a disclosure schedule, which is where you're making a lot of representations about the status of the company. And we've automated that part. So what we can do is from the term sheet that you put together, we can automate some parts of the drafting of that. And that really takes out a significant piece of that drafting component of the financing stage. And be able to deliver those drafts to you, along with an hour of time we throw into this service for us to walk through those initial documents with you, because they're lengthy documents too. Part of the value that whether it's us or your attorney should be providing is helping you actually understand what's going on in those documents and why they're important. So again, the goal here is that we would have an executed term sheet in order to be able to do this. And of course, Fourscore or other attorneys or you yourself can try to you can deal with negotiating and finalizing the term sheet ahead of this piece. But the idea is you want to have a robust term sheet in place, and that's true whether or not you're using this type of service. The term sheet is really where you should be getting all the significant terms in place and agreed on. Ideally, you would have a complete cleaned up current cap table. And from there, you should be able to really kind of utilize an automation process like this. And so we charge $5,000 for this piece of the deal. And for the most part, still do other pieces of the deal on hourly, again, just because those are difficult to predict how much time and effort is going to go into that. you know, for any of you who've done a seed round, like a significant seed round where you've had a big major investor, you'll know that this is a pretty good deal. Again, there's a lot of time and effort that goes into drafting docs. And so to be able to automate a lot of it can really allow us to help cut down on those costs. And then, you know, of course, from there, there's other things you can do. Like a lot of times, if you've been raising money before you're getting to your seed round, you might have convertible notes or safes that are going to convert as part of your preferred round. And so with this, we throw in like being able to convert one class of securities. But if you have additional of those, it can add complexity to the drafting as well as the pro forma. So we add on like $1,000 for each. Like if you have additional classes of security, and you want to talk to an attorney about what that means to have a separate class of a converting security. But we also offer the ability to like manage your costs more. Instead of us just billing on hourly, you buy an actual block of time, and then we use from that block towards the financing. And that just, some clients like that because it can give you more control over how much you're actually spending on the financing. And then once the financing is closed, we have a lot of different other services that we offer at different discounted subscription rates. So we're really excited about being able to roll out this new service and to be able to, again, just automate and simplify a lot of this process. And I really hope that it'll be able to provide a lot of value for companies as you're going through what is always, even for folks who have done it a lot, is always a big undertaking, raising preferred stock rounds.
Yeah, Sean, can you scroll back down and then how long can this take to get done? Based on like this new kind of how you guys structure this now versus like how long it used to take as well, or like how long it typically takes, and then by doing it this way and kind of having all of this structured and you guys having this format, everything, how quickly can you get these things done? Because one of the things that does suck too for founders is just like the time it takes to just like close the round that like they think they have the term sheet and like it's like, hey, let's get this done, but then it's like, oh no, you have to do this thing and that and like all the stuff. So what if people's expectations, how long should it take? How long should it take too? Then like how long does it typically take to get done?
Yeah, I think that brings up a great point about when I was going through the timeline, one of the big things we try to do with any client who's going through a round like this is have a dedicated time to have a kickoff with you where like we walk through what the whole process will look like. And one of the main things like you want to be talking to your attorney about at the beginning is just what's involved in this round. What am I going to need to be involved with? What are you handling? Who are you going to be? Are you going to be communicating directly with the other attorneys, or how's that process going to work? Because a lot of times we have clients who come in and say, okay, they're going to put in, we're going to have a valuation of $5 million, and they're going to put in $1 million, and we're like here, we've agreed on XYZ. Can they wire the funds tomorrow? And the answer is definitely no, because but it just comes from not understanding all the different complexities here. And it's not like any of this is intentionally complex just to like make a founder's life difficult or anything like that. But again, you're giving up a lot by selling preferred stock, and that investor is giving up a lot by providing funds to your company. So the idea around all these agreements and these different terms that go into this is to protect both sides' interests and make sure there's not going to be disputes about significant resources in the future. So usually I would say that like for a seed round, like it takes about like 2 months to close these things. And that's just like being completely transparent and realistic about like all these different stages of that process. And so, when you're looking at negotiating with investors, getting drafts, opposing counsel draft, like making edits, going back and forth on those, going through the whole diligence process, getting everything set up for closing, getting everything finalized to get all the signatures in place for closing. it usually takes about 2 months. The drafting piece, and part of the reason we honed in on this, can take some time. And usually it'll take like a week or 2 weeks for a firm or a group to be able to get documents together and to be able to kind of like hash everything out that they need to in order to have a strong doc set together. And the goal of being able to automate like this is that we can get that down to like well under a week, like three days to a week. And so the idea being that like if we can take all that, automate it, get everything packaged in one place, and deliver it to the opposing counsel within 3, 4, 5 days, and wrap everything up on the doc side within 2 weeks, then you could potentially cut out a couple weeks of that whole process. And then what would determine how fast the financing is going to go is really any sort of outstanding negotiations around different pieces in the docs, or the diligence piece, like if anything comes up in there that requires additional just investor attention or negotiations.
Gotcha. Okay. Yeah, that makes sense. And there was another question. Let me see what it was. Yeah, no, that makes a lot of sense. Are there other, when you're doing preferred shares, okay, here's the question. So when you're doing preferred shares, do all seed rounds in Series A investors, like when you've worked with venture capitalists, right, and they're, someone's doing their first price round or a price round, does it always do they always want preferred shares? Can there be an opportunity, I guess, for you to not have to? I know you don't have to issue preferred shares, but have you even seen rounds like that where there's notable VCs coming in and they are okay with not doing preferred shares, or is almost every term sheet you see they have clauses in there for preferred shares?
Yeah, I would say it's very rare that once you're getting up to pitching or soliciting funds from big groups like a VC, it's very rare that they would accept anything less than some type of preferred stock.
Right.
But I say that's rare because it does happen sometimes where they're comfortable with common stock. But anytime that I have a client come to me and they've received a term sheet or they've discussed terms with a significant investor who does these deals regularly, and that investor is just asking for common stock, I'm surprised. It's a good thing. It's great for me, but it's surprising, and that's just because it's rare. Usually you're going to want that preferred protection.
For sure.
A lot of this though depends on how much you're raising. So you think of a seed round being maybe up to 5 million, and then you call it a Series A. It's somewhat arbitrary, but then you call a Series A anything 5 to 15 million. But so if you think about you're raising funds and it's just someone just wants to put in 100,000 or 200,000, and you can't get all of the funds together to raise a full $1 million round. Well, that usually doesn't make sense to go through this kind of whole process, or even a simplified version of this process to sell preferred stock, because it just won't be worth it for the amount of funding and time you'll spend putting all this together. So that's why you for something like that, you would probably stick with convertible notes or safes. But even then, usually that investor is going to want, if they know what they're doing and they're a regular investor who does these types of investments regularly, usually they would expect to do either a convertible note or a safe, because again, at some point they'll get preferred stock. So it's rare that they would be fine just getting common stock.
Great. Another question here that's coming in. Say you do a preferred, you issue preferred shares for the first time during your seed round, take care of all that. You're going into your Series A now. You're going to issue to new investors. You're going to have to basically redo the whole thing in a sense and reissue more preferred shares? Do the previous investors have then the same kind of preferred shares as new investors? Or are you going to need to issue like a different class as well after that? Or if you kind of class, they're just getting it at a different price point?
Yeah, it's a great question. And so usually what's going to happen is that you'll, like, as you're going along and you're doing your different preferred rounds, you'll kind of be stacking new classes of preferred stock on top of the, like, any sort of existing stock you have. So you can think, if you've never done a price round, you just have common stock. And again, maybe you have some safes or convertible notes on the side. Yep. But whenever you do the price round, you think of the common as kind of your base, and then you're going to be stacking a preferred stock on top of that. So sometimes you'll hear the term of like a waterfall in terms of the like liquidation preferences and stuff that these preferred stockholders will get. Yep. That's why I like to use this kind of stacking, so that you'll have your first class of preferred, and then the next time you do a price round, you'd be creating a whole new class of preferred that gets stacked on top of it. And so those investors would have the first preference, and then you have the second investors, and then it would come down to the common. And so each time you do preferred round, you're creating a whole new class of stock for the most part. And that's why, like, sometimes if you're just raising like another $1 million, it would be another seed round, and you might call it your seed 1 or your seed 2 round or something like that. And then once you get up to that 5 million to 15 million range, then you would create a series A class of stock. And so each time you're going to be creating a new class of stock. And so what's important to know, though, is that each time you do that, doesn't mean you have to go through the whole process all over again. Usually the first price round is the most complex because you've got to do all that cleanup work. You have to create all these initial documents, and you have to get everything in place to have any class of preferred stock. And then moving forward, anytime you're creating a new class of preferred stock, you're essentially just amending all these documents to add in the new type of preferred stock on top of it.
Gotcha. Okay. Yep. That makes sense. Cool. Thanks for that. All right. And then, yeah, PDF. So I dropped the link in the room chat for anyone who wants that PDF. It's just the bottom of that web page there, and you can check that out. And yeah, it's right. Yeah, right down there. You can download that. And if you guys want, any info, feel free to, with Sean and you guys have. You guys are based in North Carolina, obviously, but I know you guys have offices. I think Ben is the one out in the Bay Area, right? Is he still out there?
Yeah, Ben's located in San Jose. So we have folks here in the like Raleigh Triangle region in North Carolina, as well as out in the Bay Area.
Fantastic.
We have clients who are all throughout the company. All throughout the country. For the most part, if you're incorporated in Delaware, regardless of where you're located, we can represent you. And if you're pursuing a seed round, it's probably it's pretty common that you'll either be set up in Delaware, or like in North Carolina. It's pretty common for companies to be set up in North Carolina as well, because it's also a business favorable state.
Nice. Yeah, I think if you are going down the startup path and the tech route, you should definitely be a Delaware C Corp. It seems like. Have you had any instances where people had an LLC and then now they're raising their seed or whatever, bringing on investors, and not only do you have to issue preferred shares, but you also have to change their entity over to a Delaware C Corp? Has that happened?
Yeah, it happens. I wouldn't say it's like the majority of the time, but it's common that happens. And sometimes it makes sense for when you're starting a company to start as an LLC. It just totally depends on the particular situation, what your path and how you want to grow, and at what point you want to raise funds. And so, yeah, we do see clients sometimes who are LLCs, either they set up as a Delaware LLC or an LLC in whatever state they're located in. And so part of the cleanup process is converting you into a Delaware C Corp, or depending on what state you're in, a C Corp in that state. But yes, that is definitely common.
Yeah. I see Tino has a question here too. Tino, if you want to raise your hand, you can come up and ask it as well. There's a little raise hand button at the bottom. We'll bring you up here.
On the screen here.
There we go. Hey, Tino. You don't have to unmute. There we go.
Hey, Sean, Michael, thank you very much. This is super informative and deeper than most, which is really delightful.
Sure.
So I've got a very capable counsel, at least through our pre-seed phase and the safes that we've raised so far. But ultimately, they're Midwest based, and so I'm currently living in San Jose, not scaling our sales, but also doing the raise. It's a continual raise, and if we get some serious interest, one of my concerns is, okay, I've got Midwestern attorneys, SEC attorneys. They were well recommended by another founder I trust, but ultimately, do they see the deal flow that a Silicon Valley attorney would see? No, they can't. And so what I would be interested in is, shy of hiring a second attorney just to do a market check. I'd be interested in knowing what deal terms are for different classes of companies and industries.
Yeah, sure. So, so that's actually a great general comment. And I don't know if your attorneys have access to this, but there's different resources now that attorneys can tap into, and we have new resources now that we tap into where we can actually pull data about potential investment groups or different market industries that you might be operating in, or that investor groups tend to invest in, and actually collect data that gives you is very specific about potential deal terms that they've had in their deals, or potential deal terms in the industries they tend to invest in, amounts that they tend to put in, what other spaces they've been involved with. And so one thing that you could potentially ask your counsel for is ask if they have any resources like that they can actually pull.
Like PitchBook?
Yeah, so PitchBook is one of them. PitchBook's great. And it can be really helpful if you're going to start approaching, if you know specific groups that you might start pitching to, it can be really helpful for you to kind of prepare and understand what kind of deal terms those groups might be used to.
Mm-hmm. Yeah, I mean, yeah, thank you. Yeah, I've heard that PitchBook is not completely reliable either, but
it's also pretty expensive too, for sure.
That's why it's great if you can find someone like your attorney or something that has it. So
yeah, if you're in San Jose, I would definitely recommend connecting with Ben. When I was out there, that's actually how I met Ben when I was out there, actually, and then I started working with Jesse and Sean, here. But Ben's pretty well connected out there, and he's pretty well versed in the scene. So he'd be a good person to touch base with. Happy to introduce you to him too, Tino, if you want that email intro.
Absolutely.
Yeah, and I would go as well. I would say as well, Tino, that I don't know who your counsel is, but nowadays, location matters a lot less than it used to. So it could very well be that a attorney group in the Midwest does have substantial experience working on these deals. Again, particularly if they're familiar with working with Delaware corps, and they're familiar with a lot of securities work. So just be a conversation to have with them to kind of better understand their expertise specifically in the fundraising aspect.
Yeah, they've shown themselves to be very knowledgeable, and it's I've been a student of this for a while too. So Yeah, thank you. And of course, I'd love a connection with Ben. Can't have too many friends.
Exactly.
I'm typing it up as we speak, so I'll get that out here soon. Yeah, Tino has a pretty cool company as well. So he's doing a lot of stuff in the AR space, and it's pretty sweet.
We just earned our patent.
Oh,
we were just awarded the patent for the use of augmented and virtual reality as a controller for manufacturing robotics. So it's so all of a sudden you've got what you see is what you get manufacturing processes.
Right.
So customer, robot, custom product, or customized product, or standard product. It doesn't really matter.
Very cool. Congratulations. It's a big milestone for sure.
Yeah, it was a surprise. We hardly spent any money on it. It was simply just pound the stake in the ground to say, hey, we had this idea that we're building a business around, and all of a sudden we get a patent.
Right.
Now it's the seed for an entire continuation series and portfolio.
Yeah, that's great. Love hearing that.
So,
Well, hopefully you can connect with Ben. It's nice to chat with you, Tino.
yeah, likewise. Can I send you a LinkedIn connection?
Yes, please do. I'm actually going to flip over here, Mike, I've got a couple last slides here.
Perfect.
And then I've got my contact information at the end of it as well, so you can feel free to connect with me there.
Awesome. Yeah, we'll definitely make sure to share that out. We'll send also for the people who couldn't make it that signed up, we'll send out all of that to everybody. And we are recording this too, so we just rolled out our new recording feature, so it's good now that we can actually throw this up on our YouTube and whatnot. And if anyone wants the recording, just let me know. I'm happy to send that over to you as well.
Cool. So let me reshare this. Cool. The typical process is that the company's counsel drafts the documents because they're the ones who are familiar with the company. They're the ones who have done all the cleanup and everything like that. So it's most common for the company's counsel to put together the initial drafts of the documents, and then their counsel to review and ensure that it conforms with the term sheet. But you can see how these things coupled together is a great way for their counsel to essentially just make a lot of money from the deal. Because if you're covering $200,000 of their legal expenses and you're letting them draft the initial documents, you can bet that the full fee at the end will be the full $200,000. And then the last thing, like we talked about, a lot of times you're going to give up a board seat. There's going to be protective provisions that they have around things that they get to consent to in order for the company to be able to do, like selling the company or raising more money, or like creating a new class of stock, doing expanding your option pool, things like that. But if you are uncomfortable with the amount of control that you're giving up as part of the deal, especially if it's an early stage deal like a seed round, that should just be something to talk about with your legal counsel. Because you just want to keep in mind that as you go along through your company, each time you do a seed round, you're likely going to be giving up more and more and more control. So at the early stage, if you're not comfortable with how much control you're giving up, that's okay. And that's perfectly valid. And it's your company. So don't give up too much control if you're not comfortable with it. Last thing here is just kind of some little tips about what you can do to increase chances for getting a successful term sheet and getting investors to pitch in. Make sure you're really defining for these investors what success looks like for the company as well as them specifically. Again, if you think back to what we were talking about at the beginning, for a venture group or a big angel group, their primary goal is going to be a return, right? So they're going to want to know, are you going to make us a lot of money? So if you're defining success as things around the industry and the mission and things that are really important to you, that's great. But just make sure you understand that their primary goal is to have a sizable return. You want to make sure that you do your homework on the group and your industry and your company so that your pitch runs smoothly and you can ensure what kind of questions to ask them and you seem knowledgeable and familiar about what you expect from them. That's where things like PitchBook or other services like that can be valuable. You want to make sure you have everything in place with your company through that cleanup process so that it's smooth, so you look like you have your stuff together. You want to make sure you're realistic. They'll go in saying, we're going to have an IPO in the next 6 months. Like, no one's going to take you seriously. And then this kind of depends on where you're located in the country, because there's different tendencies in different locations. But if you can have an initial draft of a term sheet together, that, like, some investors really like that. Some of them will expect that they'll give you the first draft of the term sheet. That's particularly common out on the West Coast. But if you know what you need, like how much money you need, you're willing to offer, you're offering some reasonable terms, that can look very favorable for your company when you're having these negotiations.
Yeah, that's something that I was just going to mention too. Is it common for most people to, like, should they even have a draft term sheet? Should they have a term sheet ready to send people? Or should they just know the numbers that they really want, like how much they're raising, pre-money, post-money, all that, and then let the investors send them something based around that they're familiar with?
Yeah, that's why I say it kind of depends on where you are. Like out on the West Coast, it's pretty much expected that the investor will give you the term sheet. They'll give you their terms they're willing to give you. But like out here in the Southeast or some other areas on the East Coast, a lot of times the investors will ask for a term sheet. But at the very least, yeah, if you have the kind of basic understandings of the terms that you're willing to deal with, that can be really important.
All right, thanks.
Yeah, and then again, just like make sure if you can talk to your attorneys about this. There's also specific people who help consult companies through putting together investor pitches. Obviously, there's lots of resources like through Entra and other spaces where you can practice your investor pitches. But again, just make sure you know your company, you know the investors, you know what you're asking for, and you're being clear and direct and straightforward about all that. And then just last slide here was just sometimes that the process can be very frustrating if you're getting no's. And again, just keep in mind that these investors a lot of times are thinking about their return. So if you can figure out ways to de-risk the opportunity for them, if you can go through things like accelerators to kind of build the company up before going and asking more people for funds, that can also just provide more confidence. And you can think about just different ways to structure the company. And we joke about people building real businesses that aren't backed by venture groups or financings, but you're trying to really focus on creating a profitable company early. That can also help you just be able to raise funds more easily down the road. So we've got a lot of resources on our website, just fourscorelaw.com. There's all kinds of stuff. We have a whole blog, really comprehensive blog. We have a whole blueprint for new businesses, like a whole PDF set that you can download. We've got a video series that you can watch on all kinds of different topics. We have other PDF downloads on different topics like fitness for founders, some information on different spaces like IoT and cryptocurrency. So we've got a lot of valuable resources we put a lot of time into developing. So I highly recommend checking those out on our website. And if you need, always feel free to reach out to me. It's my contact info. It's just Sean@fourscorelaw.com. And I'm always happy to answer anybody's questions.
Appreciate it, Sean. I know we're coming up on time here, so I know you're a busy guy. But yeah, if anyone wants an intro, anything, has questions, feel free to reach out to myself or Sean. And I will be sending this recording out. I know a few people had to drop off early and we're asking about it. So I will be sending this out to everyone as well. And then let me know if there's anything else that you guys would like. These guys are, very active within the Entra community. They're always here to help. If you guys have legal questions, make sure you reach out to them, and they can help you, at all stages too. Even if you're starting out too, right, John? You guys are able to help people, kind of at those early stages as well, even if they haven't raised any money yet. You still work with those early stage founders as well, right?
Yeah, a lot of our clients kind of came in at the very early stage. Like we do stuff like startup packages, all kind of stuff like that. So we work with clients. So we walk through that process and timeline on our website. Again, I'll throw the link in here, as well as the link for simplifying the process. So you'll have that, and the PDF of what the offering we're doing. One other thing I just wanted to flag, and this could be coincidence, but it seems to be coming up more and more during the pandemic. Where attorneys are located, obviously a firm out in Silicon Valley or in New York is going to have much higher fees than elsewhere. But if you have an investor that's asking you to cover like $100,000 or $200,000 of their expenses towards the deal, that should be a red flag. Because essentially what you're doing is, if they're going to be putting in $1 million and they're asking you to put 200,000 of that towards their legal expenses, you can understand that it doesn't necessarily make sense for you. Even if you're doing a $5 million deal, $200,000 of their expenses is a significant chunk of that you're giving the investor equity for, but essentially just not getting that money at all towards your working capital. Similarly, if they are demanding that their legal counsel draft the documents, that should just be something to be wary of. It's throughout the whole life cycle.
Right. Fantastic. Well, I know we will be using you guys here very soon. We're actually finalizing and dealing with that whole process of our seed round right now. So I will be giving you guys a call here soon as well. And hopefully we'll be doing our Series A shortly after that as well.
Yeah, I like
that. Yeah, man, we're on the growth stage right now. Just now that we have the new app out, we're just going to be starting to do a bunch of marketing and focusing on growth. We've just been building for the last several months. So now we're excited to get out there and get moving, but really appreciate your time. Thanks for coming out. If anyone's out in North Carolina, definitely connect with those guys there. And then if you're in the Bay Area too, I can introduce anyone to Ben out there. But regardless of where you're at, they can help you. They can help you out, and feel free to reach out to Sean anytime.
Yeah. Thanks everybody. Thanks, Michael.
All right. Yeah, appreciate it. Everyone have a great night, and keep me posted if there's anything that we can do to help. We're going to be doing hopefully some more of these legal workshops as well going forward. If there's anything else that you have questions on, let me know. And then we have a bunch of other different types of rooms and events going on as well every day. So there's a bunch of stuff happening here now. So thanks everyone for coming out. Hope you have a great rest of your night, great week, and take care, everybody. See ya.